All right, let's talk about a company that started out as a scrappy Wall Street bond trading desk back in the 1980s, but has somehow morphed into an absolute global superpower. I'm talking about a firm that manages so much wealth it literally touches every single aspect of your daily life, whether you actually realize it or not. In this explainer, we're unpacking the incredible rise and sprawling reach of BlackRock. We're going to look at exactly how this financial titan transformed itself into the ultimate everything store for institutional investors, and why their recent pivot, moving from digital assets into physical, real-world infrastructure, is something every single one of us really needs to understand.
Okay, let's dive right into this. Because, we really have to ask, who actually owns the invisible bloodlines of modern civilization? Usually when we think of global power, our minds go straight to politicians, presidents, or, military leaders. But the reality? It paints a completely different picture of modern power, and it's centered right around BlackRock's CEO, Larry Fink. By quietly positioning his firm at the absolute center of global finance, Fink has amassed a level of influence that honestly rivals heads of state. BlackRock isn't just sitting around picking winning stocks anymore. They're taking control of the very systems that literally keep modern civilization running.
To really get what we mean when we call them an everything store, you just have to look at their reach. They don't specialize in just one narrow field. Not even close. Look at equities. They hold massive, massive stakes in everyday giants. We're talking 4% in Walmart, 8% in UPS. In defense, they have billions tied up in contractors like Lockheed Martin and Raytheon. And now they're aggressively moving into physical infrastructure. Everything from eyeing Panama Canal ports to acting as the gatekeeper for the Ukraine Development Fund. They literally own a piece of almost every conceivable sector on the board. It's wild. So you're probably wondering, how on earth did one single firm manage to buy up all these companies? I mean, how do you just casually grab 4% of Walmart and 8% of UPS without going totally bankrupt in the process? Well, the secret lies in a specific financial tool that completely exploded in popularity right after the 2008 financial crash. To really understand their massive rise, we have to ask, what exactly is a passive ETF? Because exchange-traded funds, or ETFs, are the exact vehicle that turned BlackRock into the corporate kingmaker they are today.
Okay, think about traditional active investing for a second. This is the old school Wall Street way where some guy in an expensive suit guesses which specific stock is going to go up and bets your money on it. It's a huge gamble, right? Very high risk. Now compare that to passive investing. Instead of hunting for that one magical winner, you just buy a pre-packaged basket of shares that represents the entire market. It's brilliant because it drastically limits the financial risk for the investor. But here is the massive unintended side effect. By managing all these baskets of shares on behalf of millions of everyday clients, BlackRock ends up holding immense voting power over corporate decisions all across the globe. They hold the shares, which means they hold the votes.
Now, right about now, you might be thinking to yourself, wait a minute, if they have all that voting power and literally own pieces of everything, aren't they heavily regulated? Well, that brings us to this incredibly important concept, passive investor status. See, after the 2008 crash, regulators really clamped down on big banks with all those too big to fail rules. But BlackRock successfully argued that they are merely a passive investor. They're just managing other people's money, right? They aren't taking risks with their own cash. And this little technicality acts as an incredible regulatory shield. It keeps them largely free from those strict banking rules, all while still allowing them to act as absolute heavyweights in corporate boardrooms everywhere. Now, what's truly staggering here is the sheer, unbelievable scale of what's happening behind the scenes. $21 trillion. Let that number sink in for a second. 21 trillion. That is the amount of global wealth tracked by BlackRock's hidden software engine as of 2020. This firm isn't just a bunch of guys in suits making gut decisions anymore. It is run by code. To put that into perspective, this number represents roughly 10% of all global financial assets. And it's all flowing through one central nervous system. And that nervous system actually has a name. Meet Aladdin, the Asset, Liability, Debt, and Derivative Investment Network. You can basically think of Aladdin as the operating system of global finance. It's this massive, highly advanced computerized system that Larry Fink's team built to simulate endless, complex financial risk scenarios, like what if interest rates suddenly spike, or what if California mortgages default? Aladdin calculates the answers instantly. It is so powerful and honestly so essential that even BlackRock's fiercest competitors, huge names like Vanguard and State Street, they actually rely on Aladdin to navigate volatile markets. But it goes way, way beyond just private competitors. The reliance on this system is so absolute that one observer noted that central banks and governments across the globe have effectively outsourced their crisis response mechanisms directly to BlackRock's Aladdin. Think about that. During the 2008 financial crash, and then again during the massive pandemic turmoil of 2020, institutions like the US Federal Reserve were absolutely desperate for help. And who did they call? They called BlackRock. They needed Aladdin's unmatched analytical power to figure out how to stabilize the entire economy. So BlackRock isn't just a participant in the market. In times of massive crisis, they're the actual architects patching the whole market back together.
So, the crucial point here is that BlackRock has already completely mastered the digital financial world. But they know that the era of seeing massive growth through those passive ETFs, it's kind of reaching saturation. They need a new frontier. And that brings us to another jaw-dropping number, $68 trillion. According to BlackRock's own internal projections, this is the amount of money the world needs to spend on global infrastructure by the year 2040. And you better believe Larry Fink is absolutely determined to make sure BlackRock owns the biggest possible slice of that pie. To really grasp just how incredibly fast they're moving on this, you just have to trace their recent acquisitions. In 2022, they positioned themselves right at the center of the Ukraine Development Fund. Fast forward a bit to January 2024, and they just dropped $12.5 billion to acquire Global Infrastructure Partners. And looking ahead to March 2025, there's a proposed $23 billion deal involving the Panama Canal ports. We are seeing a very distinct, very aggressive shift here. BlackRock is moving money out of those abstract financial assets we talked about, and they are pouring it straight into tangible, physical, real-world monopolies.
Now, you might be asking, why physical infrastructure? Well, we're talking about water systems, international airports, power grids, toll roads, data routes. This is the absolute ultimate financial prize. Why? Because these are essential services. Think about it. If you own the only international airport in a region or the local water supply, you effectively have a regional monopoly. Consumers have absolutely no alternative options. I mean, you can't exactly choose a different tap for your water or a different Panama Canal for your cargo, right? It guarantees them stable, long-term returns for decades, perfectly insulated from the usual roller coaster of the stock market.
But here's the catch. Handing over essential public infrastructure to private asset managers creates a massive clash of incentives. It's the public promise versus the private reality. See, when a local municipality sells off a water system, the promise is always that the private firm will maintain it safely for the community over the course of their 30-year contract. Sounds great, right? But the private reality, as highlighted by experts in the source material, is often quite different. The primary goal of any private firm is to maximize dividends for their investors. And unfortunately, that often means delaying really costly maintenance just to make sure they hit those strict profitability targets. And look, this isn't just some theoretical concern. The source material points directly to the United Kingdom as a really stark example of this. Following the privatization of their water infrastructure, consumers over there ended up facing much higher costs, and the system itself suffered from massively polluted water. Why did that happen? Because when push came to shove, corporate profits and shareholder dividends were simply prioritized over doing the unglamorous work of replacing old, failing pipelines. It takes this abstract idea and makes the very real-world cost of these long-term privatization deals incredibly tangible for the everyday person. Let's move along and see how this builds, because this strategy evolves into something even more sophisticated for massive projects, particularly in devastated regions. Financial professionals actually call this the catalytic capital strategy. Here's how it works. Step 1, target an area that needs massive reconstruction, like a post-war zone. Step 2, negotiate with governments and global banks to basically use public taxpayer money to guarantee the initial capital and the returns. And then step 3, private investors come in and extract the profits while facing virtually zero financial risk. It's entirely designed to make investing in really unstable areas incredibly attractive to private capital. But as you might expect, this strategy certainly has its critics. As one whistleblower in the source material plainly states, BlackRock takes the profits, and the public, the taxpayer, takes the risk. This perfectly highlights the core debate surrounding these massive public-private partnerships in infrastructure. On one hand, proponents argue that it's literally the only way to quickly raise the billions of dollars needed to rebuild devastated countries. But on the other hand, critics argue that it's a completely imbalanced system where massive private corporations are essentially subsidized by the public, which totally removes the risk that is supposed to justify corporate profits in the first place. And that brings us to arguably the most fascinating aspect of this whole everything store model. Because BlackRock's network is so unbelievably vast, their financial structure is set up to generate returns regardless of the global climate. Think about it.
In a scenario of ongoing conflict, their passive tracking indexes hold massive stakes in defense contractors, meaning they see major returns as military spending inevitably rises. But in a scenario of post-war peace, they act as the gatekeeper for those lucrative publicly backed reconstruction funds we just talked about. Objectively speaking, they are structurally positioned to be a central financial player whether global conflicts are escalating or resolving. They win either way.
Which really leaves us with this final, absolutely critical question. What actually happens to our society when the invisible infrastructure we rely on every single day, our water, our roads, our rebuilding efforts, is completely outsourced to a private everything store? BlackRock has already mastered the digital markets, and they've completely shaped the corporate world through passive investing. But now they are literally buying up the physical world around us. It is a fundamental shift in how modern civilization is owned and operated. So at the end of the day, we have to ask ourselves, who really owns the board you're playing on?